Hi, I'm going to create a quick explainer for question number 4, version 1 in spring of 2011. And this is the income and cash flow statement one. These are, hope they're supposed to be some fairly easy income and cash flow statement problems that you can easily do on a piece of paper in a relatively small amount of time. The first one is a loan, and it's designed to be a simple loan. It says that you're taking a $20,000 loan in year 1, so you know you're getting a bunch of cash then. And it says that you're going to make a single payment in year 2 and a single payment in year 3. This saves you from having to figure out all the interest payments and all the principal payments for 12 within a year. So it's nice and simple. So you know that you're going to have to make some kind of simple amortization table to split the interest and principal payment up. And it tells you that the interest payment on loan is 12%. Last two pieces of data are that the combined tax rate is 40% and the minimum acceptable rate of return is 20%. Now let's switch on over to the spreadsheet where I have this sorted out. Now the first step on this is to create an amortization table, and this is what this bottom chunk is right here. And so what you're doing is calculating what the payment would be on this particular loan. So you're borrowing $20,000, and so what you need to calculate is looking for A, given that you know P. The P that you know is the $20,000. The effective interest rate is 12%. I made it nice and easy there. You're making 2 payments. So what I have right here is just the payment function that you use within Excel, but remember it's just looking for A, you know P. And that's the same in both years 2 and 3. The interest, and this is going back a ways to our loan examples, all you're doing is taking your current balance remaining. So if you take out the loan, what you owe as your balance remaining is the amount that you borrowed. And so this just says you take your $20,000, you multiply it by the interest rate, and that's the interest part of this payment that you're making. So out of the $11,833.96 payment, $2,400 of that is interest. And that leaves the balance as being your principal payment. So every time that first payment of $11,833, $9,433.96 of it is a principal payment. So what you do is you take that $20,000, you subtract off that principal payment, and so after you're done with your first payment, you owe $10,566. Move down to the next year. This is year 3. The payment's still the same, but because your balance remaining is less, it's only $10,566 right up here. The interest payment on it, so that's the interest expense, is just 12% times $10,566. So out of that $11,833 payment, $1,267 is interest. What's left over is going to be the principal payment, and that's exactly what you still owe. So this is a fully amortizing loan. So that's that chunk of the amortization table you need to create in order to make it so that your income and cash flow statement look right. So let's go up to what we're going to see first in year 1. This should not be complicated. All that you see here is in the cash flow statement, this thing that says $20,000 cash. There's been no change in operating revenue, operating expenses, there's no interest yet, you just got this money in that year. Simple. Year 2 is where things start to get complex. So starting up in the income statement, you've got that $2,400 worth of interest, so it's this data down here. We're transforming up there, and so the first year we're going to have interest expense of $2,400. The second year, year 3, $1,267. So it's exactly those two numbers again. And what you do then is turn those into your nice negative numbers. And so what you're doing is saying operating revenue, which is no additional operating revenue, subtracting all these expenses. We have no depreciation, none of that stuff. So what we're going to see is that our taxable income, because of this loan, actually falls. So in year 2 it falls by $2,400. In year 3 it falls by $1,267.92. Each case is just the amount of the interest expense. What I've done then is done the approximation, saying that we know that the tax rate is 40%, and just said, well, what's 40% of the taxable income? And that's going to be what those taxes are. Now remember, sign convention here says that if you see negative taxes, it means that you're actually lowering the overall tax burden of your firm. All right? So you have lots of other things going on, but the taxes you pay are going to be lower in year 2 by $960 because you're taking out this loan, and that's because of these additional interest expenses. Net income is just your taxable income less tax. So your net income is lower this year by $1,440, and in year 3 it's lower by $760.75 than it would be if you had not taken out the loan. Now what happens after that is just more transferring of data. If you go to cash flow from operations, there are these two values right here for net income. These are just exactly what was there above. There's no depreciation. We didn't buy any assets. There's no change in working capital. There's no gains taxes. We didn't go ahead and sell anything. But there's these other two numbers that show up here. These are actually, from your amortization table, the two principal payments. So you got to remember that you're splitting your loan up into these two components. The interest part goes up top in the income statement. The principal payment goes down below in the cash flow statement under finance. And so in each case you had cash leaving the firm equal to the principal payment. In order to find out what the net cash flow is, you actually just take all these items together in the cash flow statement and add them together, because that's the sign convention. You'll see that in year 0 you had a net cash inflow of $20,000. In year 2 you had a net cash outflow of $10,873.96. In year 3 you had a net cash outflow of $11,326 and I think it's 79 cents. So again, that's the sign convention. So that's what the table should look like. In order to figure out if it's a good loan, all you got to do is, of course, take the present worth of these things, and I've done present worth via brute force of those three values. It doesn't matter what you use as the base year. And I find a positive $372, which means this is a good loan. It's one that you'd like to take. And I hope that explains the first of the question 4, version 1 in spring of 2011.